Hello and welcome. You're watching Business Today Television. I'm Sakshi Patra, and in this video we're going to be talking about HDFC Bank, the rather underperformer which has rarely done anything for investors. It has really tested investors' patience for the last 3 odd years as well, with no virtual returns coming in on the bank, where every bank has outperformed HDFC Bank, and the PSU banking space has rather emerged as the new outperformer or the new banking majors where investors are keeping their keen focus on. But in this kind of a downturn, it is mutual funds that are betting big on HDFC Bank. Mutual fund houses have bought shares of HDFC Bank worth nearly 14,000 crores in the month of January, following a dip of 14% in the blue chip bank stock during a month after the disappointing Q3 results as well. Remember, mutual funds owned 136 crores of HDFC Bank shares in January. That's up almost 7% from 127 crores of shares that were held by the mutual funds in the month of December. This has been indicated by the buying of a huge amount of shares coming in on HDFC Bank, and this data is from Prime Database. Now, around 560 schemes had investments of 1.99 lakh crore rupees in HDFC Bank. 2 schemes hold 10,000 crores worth of shares in the private lender as well. And SBI Nifty 50 ETF had the highest exposure at 19,899 crores, while SBI S&P BSE Sensex ETF had an exposure of 14,211 crores. Around 517 schemes have exposure less than 1,000 crores as per the ACE mutual funds data. The data also includes investments from the passive funds as well. Around 78 schemes have increased their holding in HDFC Bank in January on a month-on-month basis. However, 461 schemes had also reduced their stake. But around 6 mutual funds had an exposure of more than 10,000 crores. SBI Mutual Fund had the highest exposure to the tune of 52,918 crores. HDFC Mutual Fund had an exposure of 23,686 crores. ICICI Prudential Mutual Fund and UTI Mutual Fund had an exposure of 19,990 and 18,707 crores respectively. A fresh round of downturn in HDFC Bank shares, which have been underperforming the benchmark index from the last 2 to 3 years, began last month after the largest private sector lender reported flat net interest margins on a Q-on-Q basis, despite the withdrawal of the ICRR and a sharp decline in the LCR to 110% in Q3. The average growth of deposits was too low compared to the guidance as well. Earlier this month, we've also seen top global brokerage houses betting big on HDFC Bank and asking investors to buy the dip. Jefferies' Chris Wood tweaked his India long-only portfolio to reduce his stake in HDFC Bank by 2 percentage points. In the meantime, we saw that India's largest domestic investor, LIC, got RBI's not to hike their stake up to 9.99% in HDFC Bank within the next 1 year. HDFC Bank stock is trading at a decadal low valuations of about 2.1 times to book value. Not just LIC, but other long-term investors are finding value in the stock. Global broking firm Macquarie has maintained an outperform rating on HDFC Bank with a target price of 2,075. The Global Investment Bank is of the view that it will take another couple of quarters before one can see the net interest margins improve and the core profitability growth as well. Remember, earlier CLSA had also hiked the target price on HDFC Bank from 1,900 rupees earlier to 2,025. Axis Securities has also raised the target from 1,800 rupees earlier to 1,975. Bernstein has maintained an outperform rating on HDFC Bank with a target price of 2,200. ICICI Securities has gone ahead to raise the target from 1,750 rupees to 1,850 rupees as well. And there you have it. Top global brokerage houses and top mutual funds are all betting big in this downturn and downward cycle of HDFC Bank. And perhaps this is the news that led to HDFC Bank shares finally rising about 2% odd in trade today as well, and therefore contributing to the sharp recovery in the Nifty that was seen today from the lows of the day as well. Do you have HDFC Bank in your portfolio? Would you want to buy the dip on HDFC Bank? Well, do speak to your own financial advisor before taking this step as well. Many thanks for joining us onto this special edition.
Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.
Hello and welcome to Business Today Television on India Today Group. I'm joined by a seasoned bureaucrat who's also the chairperson of IFSCA, K. Rajaraman, joining me on Business Today Television. So thank you for speaking with us. I'm going to start off by asking you that a lot of Indian companies are now planning to move to GIFT City from similar jurisdictions. Does this favor and bring about a good regulatory pathway for them?
The idea